Welcome. My name is Paul Mitchell. I'm a professor of agriculture and applied economics at the University of Wisconsin in Madison. I'm also extensive state specialist in cropping systems management and director of the Rank Agribusiness Institute. In this short video, I want to just talk briefly about crop insurance for Wisconsin farmers in 2021, and then some new products that are available, SCO and even more recently this year, ECO. What I always like to remind farmers is that in general, most Wisconsin farmers like to buy revenue protection and use a 75 or 70 to 80% coverage level. Roughly 75% of all corn and soybean acres in the state in any given year are insured. Revenue protection is used on roughly 90% of those acres. It varies a little bit, but it's definitely the most popular. And then in general, farmers like to use enterprise units. All your corn acres in one county are in one large unit. You just have to be eligible by having 20% or 20 acres of your insured acres in two different township sections. Most popular coverage levels are that 70 to 80% level. 75% is the most common at about 45% of all insured acres. Then the 80% coverage level, which is on about a third of the acres. Then 15% use that 70% coverage level. But between those three, that captures by far the majority of all coverage levels used by Wisconsin farmers. So revenue protection with the 70 to 80% coverage level is used on 65 to 70% of all planted acres in the state in any given year for corn and soybeans. What's really nice about revenue protection and why it's so popular is your revenue guarantee increases if the price goes up during the season. So you planted at one price, by the harvest time, the price has gone up, your guarantee increases. What I always like to remind people is that means you will have the grain or money to buy grain at harvest time prices to satisfy any contracts you sold or to feed your livestock. So what that means, you can market more aggressively. So this is a year with these high harvest time prices that we're already seeing for, on the Board of Trade. I think this is a year to really think carefully about your crop insurance, that you're happy with the coverage levels and the options you've chosen. If it's really worth meeting with your crop insurance agent and talking to him or her about it. Also think you should think about marketing very much this year. This is a year to lock in these margins and merge or combine your crop insurance and marketing decisions to take advantage of these high prices we're seeing right now. The new policies, or relatively new policy, is supplemental coverage option. It's been around a while, and what it does is it lets you insure part of your revenue protecting deductible with a county policy, the area of revenue protection. It's layering individual and county coverage. Still locked in, you can't go above 86% of your total coverage, if you will. And so what you do is you add it on top of your RP policy to move your protection all the way up to 86%. So if you bought say a 75% coverage, you could get it up to 86%. But that's with a county policy. So as it says here, SCO will not pay until your county loss exceeds 14%. County revenue has to be 14% below its guarantee or its long run average. And then 65% premium subsidy is what's used. So it's very much like the regular crop insurance. You're going to pay for it, but it's going to be roughly the premiums that you would see premium-wise in terms of subsidy is about the same for SCO as it is for regular crop insurance policies. The big point about it is this year, and this has always been the case, SCO is only available if you elect price loss coverage. If you choose ARC, acreage risk coverage, you aren't able to use the SCO option. You aren't able to buy it because SCO and ARC are very similar to each other in a certain sense. Just a sense of how much it's being used. In 2020, we had a little over 1,100 farmers buy SCO in Wisconsin here, mostly on the corn side, 830. But you can see people are starting to buy it. But last year, we had such a good crop production year in 2020 that there were no SCO indemnities paid. Here's a graphic to kind of help understand how it works. The first thing, that top line is the expected revenue or yield. It's your yield history times that Chicago Board of Trade or the Mercantile Exchange price. That's being determined now in February for harvest time prices. So it's the February average of December corn futures or November soybean futures. That's your expected revenue. When you choose your coverage level, you're choosing a percentage of that. That's that green part with the individual coverage. Say you bought 75% coverage. Well, that means if your actual individual revenue that you get from selling your grain is 20% below your average, you're not going to get an indemnity. That's your deductible. That first 25% of your actual revenue being below your expected revenue, that's your deductible. What SCO lets you do is cover part of that with an county policy. And that's what the little pink peachy color on the left side is. So you go from, say you bought 75%, you go from 75 up to 86%. That's on the county policy. and then you still maintain the same individual coverage. And so it's a way to cover from shallow losses and then get your overall capture, hopefully more of your expected revenue. The way that I like to think about it is there's 4 outcomes that with you do combine these two. You can have SCO pay, but not revenue protection. For example, the county yield is down a little bit, but you were fine. Maybe it was somewhat dry, but your land is an area that isn't bothered by dry years so much. So SCO pays, but your crops were fine. Option 2, revenue protection pays, but not SCO. Maybe it's a regular year. You got hit with a hailstorm. It was very localized, didn't affect the county yield very much. It stayed high, but you had a loss. Both of them pay. That's a good year. Maybe an example of a good example of a year like that would be a year of a wider spread drought where your yields are low, trigger a payment, and the county yields are low and trigger a payment. And then you could have a year like 2020 where you had good yields and prices were good, and the county did as well. So nobody got paid for insurance. So here, I kind of went through this mentally already, but suppose you have 75% coverage on your corn, 25% deductible. You add it all the way up to the 86% for SCO, the max you can buy. Say it's outcome 3. It's both of them are going to pay. It's a drought year, maybe. Suppose county revenue is 80% of average, and your revenue is 65%. Well, that means you're going to get a 6% payment from SCO and 10% payment from RP, your revenue protection policy. That's how these policies work. And you can see yours outcomes and the county outcomes are correlated, but not perfectly. So a lot of farmers are thinking about using this as a way to cut back on their individual coverage level and ride in the county policy more. That makes sense. Maybe if you're very closely tied to the county, when you have good years, the county does, and vice versa. The other people are thinking about it as just a way, when we have these really good margins, not to change your coverage level, but to use that county policy to capture more of this high expected revenues we have for a year like 2021, where Board of Trade prices are quite good right now during the month of February for harvest time prices. So there's kind of 2 options. Do you cut back and try to use the county policy more, or do you actually try to capture as much of these margins, positive margins, you can capture right now? That's 2 ways to use this SCO. It's generally available in the whole state of Wisconsin, where our major crop production areas are. All counties for corn, most counties for soybeans and wheat, unless you're way far north. So check with your agent if you're in those areas to make sure you can or can't get it. The other thing I want to briefly talk about is ECO. It's brand new for 2021, never been sold before. It's called the enhanced coverage option, and it sits on top of SCO yet. And so you can go from 86 up to 95% of your expected revenue. So this graph flips the county and farm around to opposite sides, but say this farmer bought 75% revenue protection. You have SCO from 75 up to 86%, and then you have an ECO going from 86 all the way up to 95%. So it's a way to really capture and lock in a big chunk of that expected return you're going to get if these high prices continue, just to make sure you get it in case you have the prices fall apart or your own yield does. A couple things that are different. First, it sits on top of SCO, and so you can use ECO though whether you sign up for ARC or PLC. It doesn't matter which one. And so if you sign up for ARC, you could do revenue protection, and then on top of revenue protection have ECO and have a gap in the middle where SCO you're not able to buy, or you can do PLC and do all 3. And so it's kind of makes things a little, you got to be careful about that, just thinking about it. The other thing to note is ECO has a smaller premium subsidy, and that means you're going to pay a larger portion of the premium, so it will be more costly to capture that last, up to 95% of your expected revenue. So if you're thinking about it, again, this is a chance I would talk to your crop insurance agent. And what I would think of it is how much you're willing to pay to lock in some of these high expected revenues people are looking at right now with these high harvest time prices.